To run us through today's session, I'd like to welcome Julian Evans, partner at Crestview Strategy, who's going to be our moderator for today. Also joining us on stage, we have Vivek Dharni, Head of Mergers and Acquisitions for Africa at Mota-Engil, and Artem, Volynets, Chief Executive Officer at ACG Metals. So, as with all panels, feel free to put your hand up if you have any questions for our panelists, but I'll pass it over to Julian.
Amy, thank you very much. Hope everybody had a good lunch, and you're looking forward to today's panel with the Dealmakers talking about the impacts and opportunities through M&A and mining. My name is Julian Evans. I'm a partner at a public affairs agency that does a lot of work in mining, helps with regulatory issues and fundraising from governments and foreign investment approvals and all those fun things. Before that, spent a lot of time at BHP and Rio Tinto in mining M&A, and I am on the board of Canada Nickel, who's represented here this week. So we really have a couple of great panelists, thought leaders in M&A and mining finance. They're here to express their personal opinions, not those of their organizations necessarily. So, but please feel free to ask them all sorts of difficult questions if mine are too easy. So Vivek, head of M&A Africa at Mota-Engil, I'm really looking forward to his views, particularly on mining infrastructure. He spent some time at Rio Tinto, as I did. And then I'd really like to recognize Artem Volynets, founder, CEO, and chairman at ACG Metals, who really is a leader in the field of mining M&A and did some quite amazing things at UC Roussel and of course Norilsk, and has dealt with copper, gold, aluminum, nickel. So. All sorts of exciting things to talk about today. Just a few introductory comments from me. First of all, the first time I was here in the Gulf working on mining investment was in 2007, and I think about where we are today in the region with the Future Minerals Forum. Going to have the 4th edition in Riyadh this coming January. I am Canadian, so I'm going to mention. That Dominic Barton, Barrick, Mike Henry are all very, very present there. The majors, and it has in a few short years turned into quite an incredible meeting of mining investment and M&A voices. And I'm particularly interested to see another Canadian, Pierre Chenard, as the CEO of Manara, and as Saudi thinks about the gold and phosphate that they have on the ground in their country, but also their focus on copper, iron ore, nickel, lithium, and how they want to use M&A to secure long-term offtake and supply of those commodities as they think about how their economy, which is I think 52% of GCC economy, is going to withstand, a transition, the green transition. And but looking at the news this week, it sounds like the Japanese are ahead in the first quantum Zambia copper situation. We obviously saw a lot of action with BHP and Anglo American in the last months. So I think we've got a lot of interesting topics out there. So I'm going to turn it over to the panelists. And start by asking a little bit about where we stand here today in November 2024 with regards to appetite for M&A, particularly in the region. And I'd like to get their thoughts on key targets and opportunities. So maybe Vivek, I'll start with you.
Sure. So I'll probably start with a question, and I'll try to answer that question myself, which is, when we talk about this region, what do we mean by this region? One of the things is when Dubai over the years has evolved a lot. There was a time when London, South Africa, basically Johannesburg, and to some extent Paris was the right destination from a capital flow perspective to Africa. Today, I think Dubai has taken that role. So Dubai, when we talk about region for Dubai, or the UAE for that matter, it's the Middle East, it's also Africa, but it's also parts of Asia which traditionally have not really, looked upon as the destination for capital from Dubai per se. So that's the first thing. The other issue is that when we talk about the region, even when we talk about Africa, it's very difficult to look at Africa as a single monolith. You've got Southern Africa, which is completely different to Eastern Africa, which is completely different to Western Africa. So is Central Africa. It's not only the regions, but even within the country. If I take the example of the DRC, which is a place where a lot of majors are looking at today. Also, a lot of junior miners extremely, excited about potential for even lithium as well as copper. The fact is that the DRC as a whole has regions or provinces where the risk, where the risk of doing operations is completely different. So when we consider all of this, I think the question, we need to be a bit more, let's say, specific when we talk about what's the appetite for M&A in this region. Having said that, I do believe there's a lot of dry powder, there's a lot of large majors, as well as private equity fund, as well as family offices, which are looking at investments in Africa, even in Saudi Arabia for that matter. But the fact is that I don't think there are enough number of bankable projects at this point of time. The real gap, even in M&A, actually lies in this space, which is the early exploration to taking a project to feasibility. I think that's where really the gap is.
Thank you. Artem.
This is after lunch spot, so a very sleepy session usually. So maybe we should bring some entertainment into the room.
Spice it up a little bit.
That's right. So size matters. In M&A, size matters. It is much easier to do a big deal than a small deal. It's much easier to raise funding for a large transaction versus a small transaction. This region, if that's your question, is about, as I'm correctly fully agree with my co-panelists here, is becoming central into financing transactions, not only in Africa, but also in Latin America and other parts of the world. ACG Metals started its life as a SPAC. For all my sins, I listed it in London. I probably should have considered Abu Dhabi or Riyadh. But I would not be surprised if in not too distant future, we will have a listing in one of those stock exchanges, because we do expect the investors for our next transaction will come from this region.
Can I just add? So, to the point just made, in fact, as a company, Mota-Engil, we're largely a company which started out of Africa, but today is listed and headquartered out of Portugal. Most of our investee companies are either today listed in Toronto, they're listed in London, or they're listed in Portugal, plus a few in Australia. But to be honest, one of the next assets that we're really looking at bringing onto the market, we're very, very seriously considering ADGM. So it's most likely going to be listed here.
I'm going to take Artem's invitation to spice it up a little bit with my follow-up on that same theme. So I'm going to ask it in a way that I think a lot of people in this region, to use a lens that not a lot of them are using, but that people in the West are definitely using. So one of the things that I have to do in my day job is speak to a lot of mining companies that were used to, pretty liquid capital markets, say in Toronto, and a good ability for a junior company to raise equity capital when they need it for a good exploration program, and even to mid-sized companies that are looking to do M&A, and those markets are challenging right now. I don't need to tell people in this room that. And so a lot of times, companies showing up at auctions are Chinese companies. And in the West, that has become an incredibly challenging dynamic. And that's probably an understatement. It is sometimes now there's a complete block on that situation. So to flip that on its head, what opportunity does that present to acquirers generally, to investors in a region like this one, and perhaps more broadly, because friendshoring is a reality in the West. As of now, people are not tying it to inflation. I think they may at some point, but today they're not. So strategically understanding whether a critical minerals, an EV supply chain, sits in the sort of Western sphere or in the Chinese sphere. Where does this region and where do some of the acquirers that you look at and speak to, fit in that equation? Maybe Artem, you'll have some thoughts to start.
As it comes to this region, it happily sits in the middle of all the funding flow from all of the places in the world, right? As we all know, from Russia to China. But if it comes to our company in particular, in today's world, you have to make a decision which side of the new Cold War you're in. We are very much on the western side of the supply chain. We are building a copper roll-up. We're building a big copper company through a series of roll-up transactions. Now, I've done something in the past similar in aluminium, resulting in the second largest aluminium company in the world. Now we're looking to build a $10 billion company in 5 to 7 years, starting from a very small space. But here, when we do that, we actually do not compete with Chinese. Because when you go to a particular host country, they ask you first question, are you Chinese or you Western? Right? And they have a preference, depending on the country, where the capital comes from. We say we are a Western company, we listed in the London Stock Exchange. They say, okay, and then you compete with other potential Western acquirers. But that is a different story. The big boys are not looking at the type of copper assets we're looking at, which is 20 to 100,000 tons of production. The junior companies do not have the same access to funding that we do. And mid-tier companies have a strategic disadvantage against us because they have a lot of committees, they need to write a whole bunch of reports, they have very slow decision making. The only way to get ahead in M&A game is a speed of execution. Everything else is a given. You always find money for a good transaction. You always can, attract right people, get the technical thing right, etc. But it is a speed of execution that can you get ahead.
Sometimes I do have controversial views. So this is, again, just to re-emphasize, it's my view. Now, I don't really think there's a difference between a Western company versus a Chinese company in a number of ways. Yes, we are a company which is listed out of Portugal, so we do claim to be Western. But the fact is, if you look at the biggest majors, their biggest stakeholders are Chinese stakeholders. You look at BHP, you look at Rio Tinto, their biggest shareholders are Chinese, their biggest customers are Chinese. So what really is Chinese versus non-Chinese? I think the core difference really is in terms of the standards that we apply in developing projects. And to that extent also, I think there's a balancing that's happening. Now, I've been working in Africa for the last 10, 12 years. I've traveled a lot, I've met a lot of governments. One of the concerns that the governments really have, and specifically when we talk about strategic investments today, is that governments don't want to be played for strategic gains. They want commitment to the country. They want you to be there for the long run. So again, I'm coming back to Mota-Engil, which I work for. We've been present in Africa for the last 70 years. Countries that we've been in have had their cycles, we've remained there. Most of our employee force tends to be local force. So while we do adhere to Western standards in terms of how we manage safety, how we manage ESG, in terms of ethics in general, but we call ourselves a local company, which is a global local company kind of thing. So, I'm slightly wary about calling this Chinese versus versus Western. I don't think that's the interest of at least African governments. They want development for their own people. They want people to be committed to making those investments. They want to be there for the long run. That's what I feel.
I think your point is really interesting around the tie between certain majors and China. And I think as governments, I think you have to remember, governments don't really have an understanding of critical minerals, right? Beyond the usual mining and resources departments. They're learning and learning and learning in the last few years. And I think as they learn more and more, that's going to be an area of risk and focus. Okay, part of my first question was about key targets, and I think my guests were, maybe I don't know if they answered that question well enough, so I'm going to ask it again in a different way. Artem, you spoke about copper roll-up strategy. So could you talk a little bit about some of the trends you saw this year in M&A activity and patterns, any macroeconomic factors you want to highlight, but maybe talk a little bit also about 2025. Probably no shift in commodity focus for you, but if there's any commodities in particular you want to highlight, what is going to be the headline at the Future Minerals Forum in January 2025?
I don't know what the headline is going to be, but I certainly know that copper is not going to disappear as a key sector. Unlike other critical mineral sectors, copper is much less volatile and has a significant degree of diversification among the suppliers and end user sectors of consumption. Unlike in nickel, you don't have one country. Well, Chile is 24%, but it's not Indonesia with 40% of supply in nickel, or cobalt is DRC. So I think copper will be a key thing, and we are very much focusing only on copper. Only on acquiring producing mines. So the nature of the roll-up strategy is you quickly do a series of transactions to buy producing mines to get scale and size into the listed platform. In terms of the themes we are seeing, there are some absurd multiples are being paid by some of the big conglomerates. You mentioned Mitsui, $20,000 per ton of capacity for copper. We are not looking at things which are, the things that we're looking at is 4 times less expensive. One would say, well, how you can find this type of targets in the producing assets? Very simple. It is personal relationship. You do not talk to the investment banks and you don't get ideas from investment banks. You've been in the sector for a long time to know that you need to avoid all the service providers and build the deals on a personal relationship in a way where it's not a one-off transaction. It is not a zero-sum game. I pay less and you want to sell me for more. Good example, the transaction we just completed in Turkey. The selling party is now our significant shareholder in the public vehicle because they will share the future upside of our growth. And you can do a lot of things whereby you avoid paying some ridiculous multiples up front instead of sharing the upside as you go forward.
I'm a recovering investment banker myself, so your words speak very true to me. Vivek?
So I've been a banker too, so and I have too many friends who are bankers for me to say anything about that. See, if we look at the market as a whole, I think the targets are very similar. Everybody is looking for the same things. Everybody is looking for metals which will help in the energy transition. So it's copper, it's lithium, it's nickel, it's cobalt. There's also, I think, a race to high-grade iron ore. Simandou being a very good example of that. The fact that the Chinese and a Western company has worked together on that. In the region specifically, see, you look for what's available in the region when you look at targets. So I think a lot of the focus will be on copper, a bit of the focus would be on iron ore. There's a lot of interest right now in the market on the precious metal side. The issue is, again, the point I think that was raised earlier by you, my colleague, which is, I think there's a difference in how operating assets are being valued in comparison to junior miners. And that, again, kind of goes back to the question of, is there sufficient capital being plowed into developing capacities for the future, because today the M&As tend to be focused on operating assets, which, yes, increase scale for the platform which is purchasing it, but does not necessarily increase the overall production. Yeah, that's what I really feel.
Excellent. I'd like you to, you've got an audience here who's obviously looking for capital and to match capital with good opportunities. What advice could you give? A lot of them are thinking about it. Take out at some point in time. Artem, you talked about the importance of size and scale. I can't tell you 8 years of BHP how it was drilled into me. Large, long life, low cost, all those wonderful things. What does an ideal M&A target look like? What deal features are you looking for? What are investors looking for today? Sure, Vivek, why don't you start?
So, through my conversations with people, I'll kind of give a general industry view. Yes, the majors tend to look for, top-tier producing assets, large in assets, low construction and operating capex. But the fact is, I think even the majors today understand they need to have a portfolio of assets, which goes from early exploration all the way to operating assets. So I do see a lot of majors today being willing to partner with smaller organizations and really have earn-in structures or similar structures to kind of collaborate and develop projects in the future. Even as Mota-Engil, we're looking at a strategy which is very similar, going from an early exploration to producing assets. But I think that's just a typical way of that's what everybody's trying to do at this point of time. My advice to people who are looking at raising capital, and I've been on both sides. I've been a lender, I've been in private equity, I've invested capital, I've been a developer where I've gone out, asked for money. I've worked with a major where money was very easy and cheap. I'm now in a different environment where we have access to capital, but potentially not as much capital as a major does. But the fact is, I think there is one major issue which stops a lot of projects from getting funding, and that's greed on both sides. There's too much expectation from early exploration projects where they don't want to take risk, they just want a part of the upside, but not really share the downside. I think that stops a lot of transactions from happening. There is also a need for some investment to bring projects to a level where the traditional players can start and make an informed decision about specific projects. A lot of focus today is on marketing rather than really on the exploration side. The other thing, which I'll also point out to is we need to be careful as to how we utilize capital. A lot of capital today is being invested in drilling, but today technology has evolved for us to do this research in also other ways which are potentially cheaper, at least to bring it to a level where the level of certainty is higher. Specifically, when I talk about Canadian firms love to drill. But the technology has changed. We don't need to drill as much to get the same level of certainty as we did at one point of time. So people just need to be more careful about how they invest capital, how much they invest in visibility versus actually the work that needs to be done on the ground.
Easier for stakeholder issues as well if you're on the ground less.
Absolutely.
Artem? Yeah.
Ideal investment target, big and hairy. You don't make money from buying small and hairy. You'll take a lot of your time and you're not going to make any money. Buying small and beautiful, yes, it's nice, but there is limited return on investment. Buying big and beautiful, look at Mitsui deal we just heard this morning. $2 billion for 100,000 tons of copper capacity. That's nice, beautiful, and big, but the return to shareholders will be many years in making. So big and hairy, where you can improve things, where you can change things, where other people are afraid of touching.
Again, the last point that he raised is a very interesting point. I think one place where there is an opportunity today is the place which is actually, I would say it's an ESG play, where a number of Western companies today are very wary of touching these assets because of legacy issues. I think there's place for people to get in, improve those assets, and then potentially sell them off.
Yeah, to me, there was always an interesting issue faced by the majors when they look at risk. And actually, this is where I want to take our final question before we wrap it up. You see a risky ESG situation, you can add a lot of value there. You can take a multiple up as long as you and your board are willing to sort of take that risk on. And I've seen that not work. And it's unfortunate that our legal framework sort of prevented the improvement of a situation by scaring people. So let's end on this note. Thinking about risks associated with M&A and obstacles, what specific ones should investors be aware of, be looking out for in the M&A world? And I wonder if there's anything specific to this region on the M&A side, on the risk side, that investors should be aware of.
Many years ago, I went to business school in America, where they told me about one important principle. It says the risk is the other side of the return. So no risk, no return. Unless you're willing to take on risk, there will be no shareholder value creation. As it comes to M&A, it's the same all over the world. Somehow there is no copper mines or gold mines under Trafalgar Square, so you have to go to some funny places in the world where you have to deal with some strange people, and therefore you cannot bet a company on any one particular transaction. You have to have at least 3 in a go, and at 1 out of 5 that works. So diversification both on the targets as well as on the operating assets already in the portfolio. That's a way to mitigate risks.
So, to the point that I started with, I think, which is, this region's not a monolith. Each country, each region has its own specific, sometimes legal jurisdictions, the way the laws work, risk in terms of ESG, environmental, social, or governance for that matter. The fact is, I think the best way to manage those skills is to make sure that you've got local partners who are actually adding value to your project than just being silent partners. The thing is that most of this region has a specific requirements in terms of local content or in terms of local ownership. So what you need to do is you need to go out there, make sure that you get partners who are adding value, who are just not on paper, but actually adding value, putting skin in the game, contributing as equal partners. And that's probably the best way of managing the risk. The other thing is you need to have a long-term view when you're playing or you're active in specifically in Africa, the region I love, completely love. And that is because you need to be willing to stay through the cycle, the political cycles. And I'll give you an example of Guinea, where majors have been present there for the last 40, 50 years. They've been political cycles, but those operations have run, completely without disruptions. There might have been some disruptions, but it's not really material disruptions that have ever happened. So that willingness to show commitment to that country and that region is extremely important. That's what I think.
Yeah, I share your view about Guinea and love of Guinea. I spent a number of years there, and I think showing commitment to Africa through the cycle is what is going to break the cycle of distrust and add some more credibility when a company talks about the fact that a mining project is the risk goes beyond the resource and extends to the human resource, to infrastructure, to energy, and to get a hearing for those points. So, listen, it's been an honor to share the stage with you both. Thank you very much. I think this audience is of the small and beautiful variety rather than the big and hairy variety, Artem. But if you have any questions, please feel free to direct them to the panelists. You can also ask them afterwards. Thanks very much.